Good afternoon, everyone, and welcome to the next panel, which will be moderated by Brian Popelka, who's the Chief Executive Officer at Bitt. The name of this panel is called Digital Currency, an Alternative to Global Rails, Problems with Existing Rails and CBDCs. That's a tongue twister. Enjoy.
Well, good afternoon, everybody. Happy to be here today, although being the moderator is a surprise that is 2 seconds.
I think actually, this is Joel Telpner. I'm the head of the blockchain and FinTech practice group at Sullivan and Worcester, and I think I'm going to do the moderating. But Brian, if you want to take it over, I'm happy to let you do it.
Joel, what a great relief this is for me.
Anyway, why don't we just very quickly, why don't you guys each introduce yourself? And so, Brian, you want to go first?
Yeah, sure. Brian Popelka. I'm the CEO of Bitt.com. Bitt is a technology provider for, getting a weird echo here, technology provider for institutions who are trying to interact with a digital ecosystem, digital currency ecosystem.
Mike, you want to go next?
So Mike Maloney, the CFO of Coinmint. I'm also an adjunct professor at Fordham Law School teaching Bitcoin in business and regulation compliance. Been in the industry since 2011 and had a number of roles at a few different places, so happy to be on the panel today.
An old-timer. Constantin?
Yeah.
So yeah, I'm Constantin Kogan, Managing Director of Way Financial. So we're an asset management firm. So we are registered asset advisors. So we run a lot of different strategies from wealth management. So also having several crypto hedge fund structures, and generally trying to build the bridge between the traditional finance and the digital asset finance. Myself also been since 2012 investing on a personal level, and got more deeper like in 2017, I would say, into the crypto rabbit hole.
I like the rabbit hole reference. Well, Gary, welcome to the party. Do you want to just do a very quick intro of yourself?
Sure. I'm probably the boring guy that you never want to talk to at a cocktail party. I build financial processing software for banks, and I've been doing it for 20 years. My first company was considered the inventor of prepaid cards. I co-founded that company. It was called Wildcard Systems in the late 90s. MasterCard bought the last company I co-founded. That became MasterCard Send. And now we're really focused on transforming how banks transact globally. And we're the first ever cross-border processor for banks. And so we enable correspondent banking as a service through an entirely new technology and business paradigm.
Perfect. Well, actually, so I promise you, Gary, you're not going to be boring today, because you're the guy that's going to tell us whether everything we're talking about is going to put banks out of business. So, I think people will be very interested in that. So we're going to be talking about digital currencies, and in particular, we were asked to talk about them in the context of being an alternative to global rails. And so, anybody want to kind of just set the stage for us and talk about kind of what we're talking about, or the universe of what we mean when we're talking about digital currencies, and so that the folks listening in know kind of what we're trying to cover here? Because I think it's probably not just crypto assets that people call stable coins, but it's what banks around the world are trying to do to digitize their currencies. So central bank digital currencies, or other types of digitized version of fiat currency. And so it's a pretty broad topic where you've got both the private sector, right, trying to pursue different things in this space, as well as governments and central banks. And so, that train seems to have left the station. And do we need them? Why what's all of a sudden driving all of this, you guys? What do you think is because there just seems to be a huge amount of activity all of a sudden in this space. So why?
I'll take a quick stab. We've had a few conversations with central banks and institutions around the globe, and I think the reality is that the conversation is just picking up momentum. And it's about as fragmented a market as any market can possibly be. I think central banks just 2 years ago were wrapping their heads around what digital currency was. Was it disruptive? Did it mean cryptocurrencies? What could it mean for me in my typical fiat currency? And as they started to educate themselves on whether or not this would be a disruptive force, or rather one that they could leverage and use for cost cutting or distribution of funds in a better ecosystem, they started to find comfort with digital currencies. Now, how it's defined across the globe, I suppose, depends on who you're talking to.
What in theory though, like are the benefits or uses? I mean, do you guys think this makes sense? Or are we just wasting a lot of time and effort? Or is this the future that we're talking about?
I might jump in on that a little bit. From the banking perspective, the idea of a digital currency or a digital dollar has been around actually for quite a bit longer than Bitcoin. We've got older protocols such as Cash that got mixed into Bitcoin a little bit. Now, as we start to move forward out of these speculative digital assets, if you would, to central bank digital currencies or stable coins, this is actually something that from a closed perspective or a non-transparent protocol level, banks have been doing since the 70s, starting with SWIFT, what was that, 76? Banks have been eager to move money on balance sheets globally and created their own payrolls for it. The reason I think that we're having these conversations now about CBDC and digital currencies is they allow for more transparency, a lower overhead ultimately, and more participation and transparent participation that builds up trust in the banking system that whether you think it needs more trust or needs to regain trust aside, it's always better to have a better system with more trust built up. Yeah. I think that's why we're landing here today with that.
Well, I think you raised a good point in that, when a lot of money and a lot of transactions have already been computerized or digitized, so to speak, for many years. I mean, most of us, or many of us, especially since the pandemic, have very seldom used cash. We use credit cards, we use other online. So things are already electronic or digital. I think the difference here, though, is I don't know, we'll see what you guys think, but I mean, I think what's part of the difference now is that it's taking the concept of digital and combining it with distributed ledger technology or blockchain technology, where people are starting to say, well, wait a minute, we can actually implement and roll this out potentially in much more efficient or different ways or different variations of what people have been able to do to date.
I think it's a bit more complicated than that. If you look at the banking system and cross-border payments, we've got to separate what is the past versus where banks are going. So the past, a cross-border payment, has changed very little since the 70s, since SWIFT. And we've got to remember that these cross-border payments, that SWIFT is a messaging protocol. It's not much more. There's no digitation of money. It's a messaging protocol. And from 30 years ago, 40 years ago until now, the way a bank originates a payment, which is coming off of the back of their core system, and in most of the 11,000 banks that are on SWIFT, and that's all globally, they're still entering it manually into a SWIFT system. They're still taking it down manually from a SWIFT system on the other side and posting it. The reality is there's tremendous innovation and automation in the old world of fiat that doesn't require digital currencies to make those massive cost takes out and efficiencies. Two of the big problems, though, that need to be addressed go beyond just the speed at which, or the efficiency at which, messaging between a bank can go from point A to point B. Fundamentally deals with compliance of currency flows in and out of a country and limitations on that really aren't addressed by digital. So regardless of how we transact or the form of currency we use, everyone needs to keep that in mind. But the second part is fundamental to all payments, and that's knowing source of funds and economic legitimacy of payments. And this is the foundational disconnect in whether, or issue rather, whether it's cryptocurrency or whether it's fiat, which is, how do you know who the business is or the entity is that's making the payment? How do you know the source of funds? And how do you share that in a way among the participating banks that they can trust that? Because the way correspondent banking works today and has worked for 50 years, the way SWIFT works today and has for since the 70s, the way Nostro Vostro accounts work today, the way core systems work today, it doesn't support that. So it is a more complicated problem than what might be kind of seen to those of us who use these systems. And it's not about either blockchain being a panacea or digital currency being a panacea. These attributes that I described will exist regardless of the asset class or label attributed to that value.
That I think that's really a great way to frame things. So how, so can you guys drill down then a little bit on that? So assuming that we start to then look at those legacy systems and update or replace them, what are the advantages or the ways that we can take, for example, blockchain technology and improve that process? Layer onto that, Gary and others, what it is that we can do going forward that we haven't been able to do in the past.
I will start. So I do think that the practical applications right now is actually use it as a currency. As we all know in the industry, I mean, it's very clear that Bitcoin, for example, it's not used as a currency at all. It's more of a store of value. It's more a commodity than a currency. And it was not designed to be a currency at all. So in this particular case of stable coins, and we can talk about what are the, I would say 3 to 4 types of different collateral that you put, some stable coins are pegged $1 to $1. So they're just, as Gary mentioned, they're just digitizing the ability to put cash in digital rails. So with that, what do we get? Peer-to-peer systems allow us to minimize the cost of transportation, so to speak, of this digital cash. And also, so it becomes more affordable. It's becoming the remittancy is a lot of, crypto projects also piggyback on this argument that one of the biggest sectors that we're disrupting is remittancy sector, right? And to just, when you send money overseas, and I went through this experience, you get charged a lot of fees for that, So that can be instant, that can be less costly. Another level, we add additional security, I would say, and it's not a popular topic, but a lot of banks actually are hacked. So by adding distributed ledger technologies, or more in common space as we hear the blockchain, we actually also create another layer of security and transparency. So because as we know, most of the blockchains, especially layer 1 solutions, they were never hacked. So. And generally, I would say the interoperability, the value add. So ideally, the exchange between the other currencies and other asset class, even that can add value. I do have also some negative points that I can bring up, which, if Joel,
part of this is let's lay it out the way it is. So please.
Yeah, just really quickly. So just to maybe, I think of myself as a person who's more like crypto rationalist. So I do believe we need to build a bridge between the traditional finance and crypto. So, but the crypto, if you look at the fundamental values of the cryptocurrency, it should be decentralized. Stablecoins are always pertaining to more centralized nature. So, not always, I would say most of the time, to be fair. And which is, that contradicts with the philosophy, so to speak, with values of the community. The second point is once you're putting it on a certain level of centralization, you lose trust. You're becoming a subject of regulations, in each jurisdiction. I mean, I'm sure Joel and other people can talk about it much more. And all of a sudden, instead of a stable coin, it becomes a little bit more unstable. Plus, we have challenges of auditing, so especially with the one that is fiat backed, more or less it's easily. Commodity backed, a little bit more challenging, but possible. But something like that is crypto backed or non-collateralized, that becomes a nightmare for any auditing company. Again, not to go deeper into that now, but
no, but I mean, the point is that when we talk about stable coins, it's a market term. It's not a, it means different things to different people. And you're right, you can have a coin that's backed by some underlying asset, a fiat currency or gold or another crypto, or it can be linked to the value but not actually backed by it, or it can be so-called algorithmic stable coin that uses some type of either automated or human involved monetary policy to maintain a value. So right now we're seeing a lot of experimentation, I think, in the market with stable coins, and we're seeing how they potentially may compete or not compete with central bank digital currencies. Maybe, Brian, it might be a good for you to talk a little bit about your project and kind of, in particular, maybe kind of what you see the use case being, and why what's the need for it, and what's it trying to do.
Yeah, I think certainly the conversation so far is we're thinking very much in our own first world places. What we've discovered and what we've been championing, of course, is sort of the genesis of the adoption of CBDCs as a legislated fiat currency. So not backed, not having a reserve against, but legislated as a same value as a physical piece of.
In other words, it is legal tender, it just happens to be in a digitized form.
That's exactly right. And so certainly in developing countries, our project right now is with the Eastern Caribbean Central Bank. It's a monetary union of 8 islands in the Caribbean. And the problem that they're seeking to solve is really the fact that 90 to 95% of their transactions are not digital today. They're not adopting credit card usage. It's still, physical dollars that are being transacted, and there's mistrust of the banking system, and many people can't. The fee structure is such that they're unable to have banking. And so our project is to pilot the idea of a central bank minting their own currency and issuing it through the traditional banking system and on into the merchants and consumers across the monetary union. There is still this idea of financial inclusion. There are people that aren't participating in the banking. And so we along with the ECCB are setting up ways in which people can still buy digital currency using their cell phones. I'm sure you know that in these developing countries, cell phone adoption is like 120%. So many people are walking around with a couple. And it is different problems. Although I think what we're hoping is that these developing country problems, if we can solve for them, that it starts to generate a use case that can grow to the tree to a tier 1 developed country to see if there are solutions that it's solving that we were just discussing. So here it's eliminating physical notes and coins as much as we possibly can. And 10 to 20% reduction of those notes and coins for these small central banks in developing countries is significant. Bringing impoverished into the financial system where they might get a home loan or a car loan or something is, again, another arrow in the quiver for people to pull themselves out of poverty. And that's certainly the hope of our project. And we hope to see that if it's adopted there, can these same use cases be adopted in more developed countries?
So, what's interesting about that, in Michael and Gary in particular, I'd love to hear you guys comment on it. But so, Brian, you just talked about a very different universe than what Gary talked about before, because Gary's talking about kind of what I would call the wholesale bank, interbank payment systems. And you're talking about kind of what I would call the retail side. You're bringing a digital currency to individuals who ultimately are walking into Starbucks or the equivalent in their country and buying a cup of coffee, using this digital currency. So let's talk a little bit about those two different worlds in how they relate to each other. Are we going to see implementation on both sides? Is that feasible? How does this all kind of tie together?
Well, let me take a quick stab, and then I'm anxious for everyone to weigh in on it. But I think that there's a reluctance from the traditional banking sector to even interact with the tool set that is required in order to manage digital in the way I'm talking about a digital currency. And our hope is that if we establish the retail, there's obviously a need for us to then what we consider unlocking the cross-border trade, so that banks that have finally been able to adopt and see that this isn't a disruptive force, and know that we certainly are proponents of regulation and compliance. Nobody's asking for this to be outside of that framework, but rather that when banks are comfortable that this is something that does fall within their compliance and regulatory framework, that then can we talk about cross-border trade? The Caribbean is a great example of a region where there are corporations who have, maybe on one island they are rich and full with money and their coffers are full, and yet on another island there's no cash, and they just need to move cash from this bank account to that bank account. And in order to do that, as I'm sure everyone here is well aware, the amount of fees that they will incur in moving that cash just to unlock their own economy is prohibitive. And so there are all these coffers of locked up currencies in the traditional sector. And what we hope is the adoption of these technologies might allow for a lower fee structure and simplify their ability to unlock their own banking.
If I can expand upon that, and I think I'm going to say that Gary will likely agree with, when we start talking about all the innovation that's coming with digital currencies and blockchain technology in general, banks are not out in the cold on this. Your bank, as much as you may or may not have a local branch, is at the end of the day a technology company now. They are funding huge amounts of investment and research into numerous things. But what Brian points out, and I think this is a very key distinction, is one, they have to abide by the regulatory reform or regulatory requirements of their jurisdiction. And two, they are not in the business of putting themselves out of business. So one of the big things that you can do with digital currency is, sorry, my dog wants to get involved in this. One of the things, sorry about that.
Days that mine hasn't so far. So
yeah, he's a big proponent of using CBDC to implement UBI, Universal Basic Income. But one of the things that we're going to see very shortly in the coming years are nations that have previously been locked out. Charlie, please stop. That have been locked out of the U.S. and Big 20, or you can even just say Big 7 banking countries, are going to unlock their economy in a way that is regulatory compliant on the international stage, but more importantly, through the partnerships that we're seeing at the government level, unlocking it for their people. Take Brian's example, take New York City. If you bank the unbanked and you make it so that these people now have access to a savings account and they have access to a provable track record of moving transactions, you've essentially established a new way to determine credit worthiness. And we're going to start seeing people gain access to capital.
Yeah, Mike, just to jump in, when we think of cross-border payments and the use of digital currencies or blockchain or DLT, what we've attempted to do and how we think about it is to actually isolate the problems that are institutional or foundational in nature and solve that for the cross-border component. And then all of the use cases that have been talked about get plugged into that. But if we can't move the money from A to B, country A to B, our objective is to move it at the speed of data from country A to B and with a similar cost. And our view is you don't need digital currency to do that, and you don't need blockchain. You don't need it. They can fit in, and they do fit in, but they're not required. So in fact, we talk about the rails. Well, the rails mean a way, it's an infrastructure way to move messaging and value, whether that value is fiat or some other form of currency or digital currency or whatever, from country A to country B within the banking system to make it happen that way, and then allow for all of these options for these, or access for use cases. And it doesn't mean that the money flows to a bank account. It doesn't mean that it flows into a cryptocurrency. It could flow into Payall in Brazil. It could flow into Gcash in Philippines. It could remain in the system, in the bank system, and accessed on a debit card. But we isolate and distinguish between the rails and the infrastructure that deal with compliance and currency controls and FX and all of that, as enabling that uber efficient way of moving value around the world that doesn't exist in SWIFT and in classic correspondent banking and Nostro Vostro and core banking systems. So we fix that. And then all of the use cases we talked about, which may be reaching an unbanked population or allowing a sophisticated banking customer transact and invest in crypto, or allowing a business to transact and engage in B2B payments, plug into that new global infrastructure system to make this stuff happen.
So the two of you raised, for me, a bunch of interesting questions. But one is that you both mentioned, you both referred to banking the unbanked. And, we hear, those of us in this world hear that a lot, that, one of the promises potentially of blockchain or other technologies is to give people that don't have access to traditional banking, finally, bring them into the financial system. So are we talking about bringing banks to people that don't have access to banks? Or are we talking about giving people the means to engage in global finance or the global economic system, and by bypassing banks altogether? Or is it both?
I think. Oh, sorry, Constantin, go ahead.
Yeah, it'll be funny because I will take more radical approach if you. I think
we'll put your phone number up at the end. So go for it.
I think it's a very I would say good marketing term. It's an amazing marketing term, bank the unbanked. But in reality, if we're talking about stable coins, it has nothing to do with the reality. Because yes, in the beautiful world that we're talking about, right now, you would not need bank to use certain stable coins. It is true. But we've seen what happened when, let's say, Libra project was trying to basically take over the role of a bank, a private company. We've seen the huge, resistance from major, jurisdictions, not only banks, we're talking about countries. They don't want to lose control. So when we're talking about digitization, we have to be cognizant of the fact that it also comes with a certain layer of losing control over certain assets. Currency wars is always part of the geopolitical domination. And I think when, if we want to be fair, the war is against cash. Why? Because it's not accountable. Why people also don't love, certain crypto assets as Monero or Zcash, or to a certain extent even Bitcoin, because, it's hard to trace, certain transactions, and people, especially countries, they lose control. They're not happy about it. But coming back to your question, I think, if we are talking about bank the unbanked, stable coins they're a better way to achieve certain solutions, but it comes with a price.
Stay on that radical front a little bit. Banks go away. I think we get banking as a service, which means that how your bank looks and appears today is going to be radically different, and it's going to be based on demand. If you want a full suite of banking services and you want the Wells Fargo approach, you'll have Wells Fargo. But if all you need is a savings account, a checking account in its digital form, and an ability to borrow and lend, then that's all you're going to need, and you're going to elect multiple bank as a service. I'm also going to kind of peeking over at the chat. I want to caution people from going and railing against traditional fiat, especially because it serves its purpose at both a local and an international level. No bank is going or no country is going to give up its power to issue currency and inflate and deflate things at their will for the reason that it's how they control the world stage. But that's sometimes a good thing. And what I really want to say is, the libertarians that love to say, we have to go against this because of inflationary models, I'm fine with that. But let's not think that we have the moral high ground. We have not emboldened the poor in America or the poor in any country with the distribution of Bitcoin. But maybe we can with the creation of digital currencies. And so I really want to caution people from taking hardline stances at this point.
Right. Well, appreciate it. Okay. Gary?
Well, I think to follow on, Mike, cryptocurrencies don't solve the problem that many people worry about, which is volatility. In fact, one could argue over the last 6 months, crypto amplifies volatility, which for some people is an opportunity, and for other people, it kills them. And so we have to, again, be honest about what are the applications for this form of transacting, and give people the choice to access it easily so they can add it to their, they have it as a menu item the same way they have a bank account, a debit card, an Alipay account, or some other way of transacting, rather than viewing it as a zero-sum game against fiat or against banks. These things will coexist, I believe, for a very, very, very long time, for no other reason than the regulators and the guys that control those regulations at the banks are going to see to it. So, and in fact, consumers want some form of protection, and protection against things that those in the commercial world that the modern digital world can't control. So I don't see banks going away at all. I do think that banks will move slowly. They always move slowly. They will differentiate themselves by using this new technology in ways they determine best satisfy their corporate objectives and their customer needs. But those of us that are involved in this ought to find great bank partners and help them succeed and win, so that we can deliver use cases that take costs and inefficiencies out of the system, rather than adding them.
So, central bank digital currencies, theoretically, as different governments have looked at various models of how to implement it, it's theoretically possible for the citizens of a country to have an account directly at the bypass commercial banks altogether. I'm assuming that you guys don't think that that's not likely to be the approach that gets adopted by different countries. So why?
Well, I'll take a quick stab at this one. Can you hear me?
Yes.
Okay. Well, they are not tooled to do so. Central banks are not banks in that traditional retail sense. And so, and are obviously by mandate risk averse, conservative, and are seeking stability as much as possible. And I think in the fact that many are exploring this digital world is, hats off to those that are even taking a look at it. Because I think, even to build on the last point, we have been very used to transacting within the jurisdiction of wherever we live. And the reality is, how can we will now be transacting across multiple currencies, whatever that happens to look like. I might be trading a chicken over here, and I might be using $1 over there and a stable coin for this. And so these mingling of currencies, that's really the question. Can banks adopt, in my mind, can banks adopt to all of these variations of currency, have tools that we're trying to explore, and a regulatory framework that allows it all to sort of commingle. And then it says, okay, if that's our new world from a global perspective, does that knock down some barriers in trade? Does it make it simpler for us to do global business, right? I diverted from your question, I think there.
No, that's all right.
I was riffing, man. Apologies.
Well, look, on when we're talking about bank-to-bank payments, I think, Gary, as you said, part of it is, are we doing anything better or different or more efficient than what we have now? and assuming that, some of the things that people are pursuing on the digital side are improvements, then at the end of the day, it's middle and back offices of banks implementing and upgrading and doing what they need to do their systems to go into this new world. But at the retail level, Brian, what's it take to seriously get this to the point where somebody that doesn't know the first thing about, for example, blockchain technology or digital keys or cryptography, and doesn't want to know all of that stuff and doesn't want to have to worry about losing, private keys and wallets. How do we really roll this out at the retail level and make it work?
Well, this is really germane to the conversations we're having and we're hoping to prove in this pilot, is that if at the application layer, I don't know how many bankers you talk to that worry about their data structure underneath, whether how the hosting is done, how we're moving through Ether today. They generally don't. What they care about is, how am I interacting with that currency today? And I'm, again, talking at the business level. I'm sure at the IT level, it's entirely different. But so it's, do they have tools that can play well with their core banking systems that allow them to interact with these currencies? And then can we teach them and their staff, which has been a real challenge for us that we're seeing in this project, how we're working with the central bank, how we're working with current financial institutions to have comfort with the data infrastructure, whatever it is. It could be blockchain or not blockchain. We're seeing that a tool in a digital world doesn't necessarily have to be on the blockchain. It could still be a traditional block or a traditional data structure. Obviously, there are, and I would look to Constantin to comment on all of the benefits that the data structure around blockchain might offer. But I think that the fact that people are engaging on the banking level with this type of data structure, it bodes well for the coming years on adoption for that type of technology, that level.
Well, are we talking about, guys, as we go down this road, are we replacing like Visa and MasterCard, or are we eliminating the role of players like PayPal? What does this look like?
So no, not replacing like most of the, like Visa and MasterCard. They also have a lot of patents in blockchain. So I don't think we're replacing them, but we are fighting against banks. That is true. So what is happening right now, to answer your previous question, I think they have a lot of choices. The trust level in a banking system right now going lower and lower, because if you look at a lot of the folks who are antagonists of the digital asset industry, they pertain to the argument of bubbles, right? If you actually look at the bubbles and any other negative arguments, they all, the traditional financial system has zero repercussions, zero consequences on the effects of the bubbles, right? So the CEOs only get golden parachutes and pat on their back, okay, you did a bad job, but you're still going to have a good compensation. So I think the trust of people where we're looking at, it's shifting. It was impossible to fight an institutional level. I think my colleagues already mentioned a few reasons why. Because our technology, the fact that we still have credit cards, which are 4 generations old, even with the freaking EMV chips, seriously, so there are groups on Telegram that are selling opportunities to hack those cards. So just so that you be aware, and those are the consequences of banks not willing to accept the adoption. And now, when the pressure is coming from below, from the people, I don't think they have a lot of choices. To give you just a few facts why I think it's inevitable. When Binance as a company is making more revenue than Deutsche Bank, one of the oldest institutions in Europe, in 1 year, when Coinbase is in 3 years getting 25 million users, something that took Charles Schwab 30 years, we're talking about a different new paradigm shift. That's why I would briefly say it's inevitable.
I'll say that I think change is inevitable, and I hope that we are working on that change and that it's the change that we have been working for. But just to echo what Constantin is saying, and to highlight what Brian's work. If the traditional banking system, which has been in place for 40 years, worked, everyone in the world would have a bank account. Everyone in the world would have a savings account. Everyone would have access to traditional finance, etc. But they don't. They don't. And you can't argue with that. At the end of the day, something needs to change. New developments are happening. And my hope is that banks embrace this with open arms. I know how difficult it is. And I know that the rules of the road for regulatory compliance are written for national safety and to protect wealthier nations. If we look at what Bitcoin has done, it started doing cross-border payments without rails. There were no safety measures. There was nothing to protect it. There was no way to handle it. And they started doing that immediately. I think now there's a way to merge those two systems and get them to work together. So I'm really hoping to see that. And I hope we're on the right track.
I would offer that I don't think that it's fault that there's only 30% bank adoption, say in the Philippines or in other parts of the world you don't have, or even in the US that we don't have, because consumers are free to choose. And as long as there are alternatives to what a bank offers, a consumer is going to choose what's best for them. Now, it's easy to argue that, and I think there's a strong case to be made, that those providers of financial services could be offering more innovative and creative alternatives, the banks themselves, I'm saying, but where they don't, what's happening is the emergence of fintechs around the world, including a lot of the folks that are probably listening in now. So I'm not a believer that banks are going away anytime soon. I'm also not a believer that if you gave a bank account to everybody, there would be people that wouldn't take it. The point is that there will be a robust and rich offering of financial services because there are entrepreneurs like us all over the world that are identifying people that are unmet or dissatisfied with what they're being offered, and they're going to create something to satisfy that audience, whether it's a mobile wallet or whether it's a cryptocurrency or whether it's something else. And when I think of Visa, MasterCard, and even the traditional guys, most of these things are simply access devices to an account. So a card is nothing more than an access device either to some form of asset, money, or access to a line of credit. And again, until cryptocurrencies become as ubiquitous and acceptance as those things, they're not going away anytime soon. Until you can walk into any shop anywhere in the world and pay for something with your cryptocurrency, cash won't go away and cards won't go away. And it is a gargantuan task to imagine a world where we have that global ubiquitous acceptance of all of these different cryptocurrencies, and they're just as efficient and just as smooth and just as trust. They stimulate as much trust as, say, using your debit card or your credit card. So I think there are a lot of moving parts here, and there's enough space for everybody in the swimming pool. We're going to carve out our little places.
So I want to talk about one of the moving parts that I think might be interesting as far as how you guys all see this driving adoption. When we talk about traditional cash or fiat, in many ways, that's dumb money. I mean, it's a piece of paper at the end of the day, and you can spend it, but you can't do anything else with it. Once we start talking about digital, we, in a way, can turn it into a product because we can add all kinds of other features and attributes to it. So can you guys talk a little bit about kind of how that starts to cause us to think differently about what we mean by money and what we can, and how we're going to use it, and how that may drive, these new rails coming online in adoption of all of this?
Well, I'll start out with a use case that we've been asked to take a look at, and of course, generally when we're talking to clients, we allow them to tell us what type of money. We don't attempt to set their monetary policy. But a lot of what we've seen with some governments is, for example, over the course of the pandemic, when stimulus money was needing to be helicoptered in, being able to provide a rail for that stimulus money, but also to sort of earmark it for certain purchases and prevent it from being used in other purchases. So Let's say you wanted to make sure that people could buy the necessities of food and fuel or something, but you don't want them going to the liquor store. There was a way with which to control those funds and where they can be transacted at through a digital means. It's obviously a slippery slope to start to say where you can and can't spend money, but if it's earmarked money, I suppose there's a positive case for how that might be spent.
Yeah, so we're talking about smart money now. What Brian just said there, that's very similar to EBT or food stamps in the United States. The United States would likely have a larger problem with direct money control. We've ruled that money is speech, for better or worse, and we have free speech. So if the government gives you $600 once in a pandemic, you can go to the liquor store with that, and we wouldn't blame you. Or maybe we blame you. There you go.
Bad example.
I certainly wouldn't.
I'll say that I think it's a double. It's a two-parter. I think smart money with settlement, or what we could call enhanced settlement, i.e., immediate payment of taxes, withholding, etc., will absolutely be a part of that. The other really interesting thing that's going to happen, and this works with what Bitt has put together, and I'm sure with some of the other projects out there, is it's going to create smart rails, or we could call them just identified wallets. So if people want to be able to access those funds or send funds, we're going to be able to put those together. It's going to be really interesting to see new financial products come out of this. But if anybody is upset right now about WhatsApp stealing your data, we may have to start worrying about spending metrics, et cetera, and maybe we tip over in a brave new world a little earlier than we wanted to.
It's interesting, though. This is one of the areas where I think you'd find heated agreement with banks. And that is that cash is their enemy as well. They don't want to be touching and handling cash. And the extent to which we're bringing digital currencies and blockchain into the mix as a way of helping them solve that problem and adding value to the holders of that cash, these are examples of how there is a bridge and there is a coexistence between banks and the newer things we're doing, because we do have that common enemy or objective, which is to find safer, more convenient, more utilitarian ways for the holders of value to transact. And digital currencies and blockchain, in some use cases, absolutely represent and enable that.
So if I can, interesting here, also to spice it up a little bit, we're talking also about the freedom. So yeah, I mean, in an ideal world, we should coexist, and the banks, we give them some time to provide. I actually give them the pat on the back on the stimulus check distribution. I think it was brilliant. And by the way, we have already Zelle, something that a lot of US customers are they can finally, it happened in Europe 20 years ago. So maybe 10, okay, I'm exaggerating, but you can, from Chase to Bank of America, you can send, let's say, $2,000. And by the way, it's on blockchain based. Not a lot of people know about that. So if they want to, they are able to improve the technology, improve, the systems, the rails, so to speak, as Brian was referring to them, and Gary as well. But I do believe there is another important topic. It's about your freedom. And I think right now what we're seeing is more and more of a concern. You have your own business. Think about how many businesses are actually, even in the United States, are running on cash. So the banks have, basically a decision making, an anonymous, the majority stake in closing your account or letting you to transact or not. Even if you deposit to your bank, to $100,000 worth of cash, you have to explain where it's coming from. If you want to send it to a wire, let's say to your parents, let's say somewhere in Europe and South America and Africa, it doesn't matter. They will ask you, provide us an invoice. They can block the transaction. They can freeze your account at any given moment. So I think this is another concern, that we also have become a slave. We're now becoming slaves of banks, who are letting us to move our money, even we earn them or not earning. I think, and not a lot of banks, unfortunately, addressing this issue. So Another interesting, really quickly on that, it's a yielding problem. Somebody, I think David, who's our active participant in the chat, thank you for that. You mentioned about the yield. Right now on USDC, on some of the applications, I don't want to make an advertisement for them, but you can make from 10 to up to 20% APY year on year. Not a single bank provides that. Like in the United States, you will probably have 1%. It's a luxury. So there is another battle for not only for hearts and minds, but also for smart yield.
Constantine, two things. One, the question the observation you raised about banks being able to block funds when they are asking where it comes from, it's because of the opaque nature of correspondent banking and SWIFT and classic Nostro Vostro accounts. There is no transparency into source of funds. A bank's primary obligation is to protect the safety and soundness of the payment system, prevent money laundering and terrorist finance. And so when there are transactions that they are unable to verify what I've just described, they have no obligation but to do that. I promise they're not trying to give us a hard time. They have a high, it protects all of us if they prevent some idiot from somewhere else sending money somewhere else to blow up the building. So, but what I believe is that technology and digital currencies and the things we're doing can help banks and regulators overcome those things so that our money does move more freely and easily. Now, on the interest part of banks, I'm skeptical of any bank that pays a lot of interest. Where are they getting their returns? Some of them are getting it from their credit cards and from their mortgage portfolios. But if we look at the cycles of the banking industry, and some of them pay just profits, but they're not getting it. In many cases, if you've got a large bank account in Europe, you're paying negative interest or you're receiving negative interest from the central bank. How do you pay 20% or 5% interest on money when you've got mortgages that are not being paid, corporate loans not being paid, credit cards not being paid, car loans not being paid? I'm skeptical of a bank that's paying some crazy amount of interest.
I'm sorry, I'll chime in, but that's the point. See, banks are redistributing their like income, that 27% APY that they're providing on credit cards, they're distributing it in-house, right? The new rails in, like, I would say, more DeFi-oriented projects, they're actually sharing more because they don't have such a high cost. They don't need to pay out like thousands of people or pay the regulators, like auditors, etc. So I do agree with you. There are pros and cons, but that's the new choice, as you mentioned.
So I think I knew this was going to happen because there's so much more I would just love to cover with you guys, but I think we're probably pressing the limits of our time. So I'll give, I don't know if Brian and Michael, you guys want to do a quick any closing thoughts as well, and then we probably will need to turn it over to the next panel.
Well, I'll be very short and sweet. I wanted to I thought Constantin made a great point as we've been exploring the adoption and the interest of digital currency with central banks around the world. Liberty and freedom comes up an awful lot. And so it's a very precious thing to talk about. And as you said, we're hopeful to be part of the solution on the go forward. And yeah, we could go on another 3 hours, but so thanks everybody.
These things are always too short, but I really want to say that this industry is going to grow because of the push-pull between Gary and Constantin. We just had the OCC come out and say that banks can take custody of crypto assets now.
Hopefully that won't be reversed, by the way. But
yeah, well, and now we've got the guy, he's on his way out. We'll see what happens. I'm hoping the next administration is going to be very friendly. But, the only way this gets better is somebody pushing and somebody pulling, and hopefully it comes together. And if it doesn't, we're just going to make our own.
Well, listen, you guys have all been awesome. I want to thank you all. And it's been a great discussion. Look forward to talking about this more with everybody. Take care.
Thanks, everyone.
Thank you.